Throughout the soaring market of the 1920s, the Republican Party stayed in power on the back of America's increasing prosperity. Calvin Coolidge became president in 1923. An investor himself, he was notably silent on the speculative mania gripping Wall Street.
Calvin Coolidge typifies the laissez-faire, devil-may-care recklessness of the 1920s. He's famous for saying that the business of America is business.
It was a prosperous period. Business was making money. Wall Street was making money. The politicians, I think, just said, well, everything's fine. The economy's growing. The market takes care of things pretty well, and the government's job is to get out of the way.
During the Coolidge presidency, Wall Street's power continued to grow unchecked. His administration had close links with an elite group of bankers and financiers, Wall Street's inner circle. Their wealth and connections gave them immense influence over the government's financial policy.
They were small, elite, private partnerships. This was really the royalty of Wall Street. These were very mysterious and discreet places. They were small firms with limited capital, but they exercised really an outsized power.
The most prestigious of these elite firms was the J.P. Morgan Bank. Strategically located directly opposite the stock exchange, it would play a key role in events to come. As senior partner at J.P. Morgan, Thomas Lamont was the most powerful man on Wall Street. His influence extended well beyond New York. Lamont and the other J.P. Morgan partners spoke regularly with successive presidents.
Grandfather was a very, very busy man. He didn't have time, as some grandfathers might, to take his grandson to the baseball game or go fishing and do things like that. Grandfather's lifestyle was certainly a very handsome lifestyle, there's no question about it. He did have his yacht, the Rennet, which was a 72-foot, very handsome yacht, which he often would cruise down from his house in Palisades, commuting by boat, if you will, down the Hudson River to Wall Street and then walk up to the bank.
Under Lamont's leadership, J.P. Morgan steered clear of the worst excesses of the stock market. But the close relationship between elite bankers and politicians helped keep government regulation of Wall Street to a minimum. While amateur speculators were transfixed by the soaring value of their investments, they were hopelessly unaware of how Wall Street really worked. With little government supervision, the market was a law unto itself, and insider dealing was rife.
There was a lot of market manipulation going on. It was rampant. There was no disclosure at all to speak of. And when Wall Street was very small and very self-contained, that was probably okay. But as people like you and me began to put our hard-earned money into the market, then it really mattered.
The stock market of the 1920s was neither fair nor democratic. It was a big gambling casino, and it was rigged by professional speculators.
As smaller investors gambled with their life savings, they failed to realize that the odds were stacked against them. Men like Joseph Kennedy did not make their fortunes by simply picking the right stocks. The truth was that they were cashing in on the naivety of gullible newcomers.
A bunch of sharp speculators would get together. In coordinated fashion, they would start quietly but relentlessly buying an individual stock.
What they would do is hype up a particular stock, buy it up themselves, and then dump it on the market so that they took the profits while the average investor in those stocks were left with the losings.
Even some of the elite investment houses on Wall Street were engaged in this type of market manipulation.
In March of 1929, a new Republican president, Herbert Hoover, was inaugurated. In his address, he reassured Americans.
We have reached a higher degree of comfort and security than ever existed before in the history of the world.
But behind the scenes, he was less confident.
Hoover is actually skeptical about what's going on Wall Street and the economy generally. But he doesn't have the political courage of his convictions. And so when he becomes president, he does nothing to rein in this wild speculative fervor. He doesn't do anything to encourage the Federal Reserve or the Treasury to tighten up margin speculation in the stock market.
Hoover was president, and he and Andrew Mellon, the Secretary of the Treasury, were way to the right and felt that it was not the government's job to interfere with this. They believed in pure, unfettered capitalism, and so they did very little or nothing to alleviate the crash. They said it'll solve itself. The market broke very sharply, and a lot of people were wiped out with it. It was very painful. Almost everybody lost money, as has happened now.
Last week, the dollar hit a three-decade low against the Canadian dollar.
The stock market suffered one of its worst days in years Monday.
Is it the worst you've ever seen in your career?
Oh, by far.
This is a financial system that is coming apart at the seams.
First of all, I don't see America having problems.
The economic team reports that our economy has a solid foundation. The economy is still creating jobs. Consumer spending is still growing. Outside experts expect that our economy will continue to grow over the coming year.
Our economy, I think, still, the fundamentals of our economy are strong.
Well, how much do you think that would bring down oil prices? By $20, $30?
You know, I don't know. You're going to have to ask the experts that. I'm just a simple president.
A number of analysts are predicting $4 a gallon gasoline this spring.
That's interesting. I hadn't heard that.
Do you think there's a risk of a recession? How do you rate that?
You know, you need to talk to economists. I think I got a B in Econ 101.
Well, I didn't frame that in the context of the campaign. It's the president who has always said that, and I'm wondering if that assessment still stands, that the economic fundamentals are strong after this bailout and Fannie and Freddie and Bear Stearns and everything.
I would tell you that from what I understand from the experts, that our economy has the strength to be able to deal with these shocks. Keith.
You didn't directly answer the question about whether the fundamentals of the economy
I answered it the way I was going to answer it, and I'll answer it the same way again. So, and if you
why won't you direct? I've never heard
Keith,
someone not answer that question directly from the podium here, that the fundamentals of the economy are sound. Are they or not?
What I said is that we have the strength to be able to deal with this crisis in our economy. And I know that you're not asking the question in the form of the 2008 campaign, but I know as soon as I say something, you're going to turn it around, and it will be a part of the 2008 campaign, and I'm not going to play the game.
Well, that's not a game, though. That's a very important
I answered the question.
I said whether the fundamentals of our economy are sound. You're not answering that question.
I did answer it the way that I was going to.
You've been looking at what officials have been saying recently and prior to this.
That's right. And over the past couple of weeks, stark and frank language increasingly about what's happening in the capital markets and the economy.
Government action in this.
It's about as dire as a president can get on the economy.
We're facing a choice between action and the real prospect of economic hardship for millions of Americans.
This from an administration that for months said the economy was vibrant, the financial system strong. The president didn't acknowledge, quote, storm clouds until last December. By then, it was raining.
There's definitely some storm clouds and concerns, but the underpinning is good. And we'll work our way through this period.
Then, with each disastrous job report or capital market crisis, an upbeat assessment. In January,
our economy's flexible, it is resilient.
In February, the president's surprised by spiking gas prices.
What did you say? You're predicting $4 a gallon number? That's interesting. I hadn't heard that.
In March, Bear Stearns was in a death spiral, and the Fed brokered its sale.
We're in challenging times, but another thing is for certain that we've taken strong and decisive action.
Our financial institutions are strong. Our investment banks are strong. Our banks are strong.
They're going to be strong for many, many years.
In July, IndyMac Bank failed.
I believe we will come through this challenge stronger than ever before.
The three trying to sell this $700 billion rescue didn't see it coming. The Treasury Secretary told NPR last year of the global economy.
It's as strong as I've seen it any time during my business career.
And again last October.
This is happening against the backdrop of an economy that, which in other respects is very solid. So far, there's very little evidence that it's bleeding over into other areas.
As the subprime crisis devolved early last year, the Fed chief.
We do not expect significant spillovers from the subprime market to the rest of the economy or to the financial system.
And now?
This plan is an emergency plan to put out a fire, to resolve a serious crisis which has real Main Street implications.
Slowly, over the last 10 or 11 months, the administration has been acknowledging the problem, always with the caveat that the underlying system is vibrant and flexible and strong.
And I have showed that if people with C averages can succeed.